So just a quick introduction. I'm Kevin Turpin. I'm the head of research for Colliers for Central Europe. I'm based in Prague. I've been living in the region for nearly 20 years. I've been in Prague most of that time. And it's great. I've seen quite a bit of change. I've been coming to Budapest for a number of years. I also like to go to Balaton as well. So I'm very familiar with the region. And as I said, it's been a fascinating journey to see how a lot of the cities and the region has developed over the last 20 years. So today I'm just going to give you a quick insight into what's been happening in the last year, and then a few ideas of what we expect to see in the next year and the years ahead. Now, these are a lot of headlines. These are not exclusive to Central Europe or Hungary. These are sort of often global problems or trends that we see that impact on the way that we impact on the decisions about investing into or occupying or building real estate. So there's a few here. Geopolitics, obviously there's a lot going on at the moment. My country is going to leave the European Union tomorrow. The President of the United States is up for impeachment. There's viruses, there's drone killings and all sorts of things. So there's lots going on in the world which could have an impact on things and could change things literally overnight, which obviously impacts on economies and cycles. And as I said, we're really in uncharted territory at the moment because we've had this very, very long growth period, particularly, and you'll see in a moment about the investment cycle coming up for sort of a 10-year cycle, which is unheard of. Robert alluded to sovereign ratings. Most of the countries in this region are very well ranked. There's a couple of downturns or changes in those at the moment, but generally speaking, most investors see this region as very safe and secure. Trade wars is another thing that's also going to have an impact going forward, and also tech wars. I've seen Huawei's logo up here quite a bit, and obviously there's a lot of concern over which technology will be in place for 5G. Will there be a split in the world? So there's lots of interesting things on that side of things, and so data and technology, by itself is disrupting, but also enabling a lot of our clients, as I said, and the way they occupy buildings and how they will do business going forward. Online sales obviously massively impacted the retail industry. We'll talk about that in a little bit, and again how they get products to people. Automotive is also touched on. Obviously, that's a bit of a concern. This transition between regular fuel cars and electric, and whether our region, which is massively reliant on automotive, and can those factories adopt production of electric cars, because quite a large part of their current setup is not geared towards that, and is electric the way forward? For a number of reasons. So electric, obviously, where's the electricity going to come from to power them? But coming back to sort of physical, rising construction costs, this is a big concern, but also the cost and availability of labour. These are also driving up the costs of delivering property, and of course that's pushing up rents. But you as developers and maybe investors are not seeing the benefits of those rental increases. It's really just covering the additional costs. The alternative sectors, we'll touch on that, but it's still very small. Flex space, co-working, and this is also making an impact on some of our spaces. But also from a personal point of view, the massive rise. I know in Hungary it's one of the highest. You've seen some of the highest rises in house prices, partially thanks to Airbnb, but also again just thanks to the cheapness of debt as well. But also going forward, we will start to run into land availability issues and permitting, which in some countries, like for example the Czech Republic, is one of the worst in the world for getting permits. Looking forward, this is a 4-year forecast. Most of Central Europe is performing very, very well, almost double that of Europe. Czech Republic cooling off, again very, very reliant and very close to Poland, Germany, like most of the markets in this region. But with Germany taking a bit of a hit at the moment, although having performed for so many years, it's still in the positive figures, but at a much slower growth rate. So the outlook there is positive, but at a much slower growth. So we can expect lower figures going forward. In terms of retail sales, we all hear the horror stories and sort of bad news around retail, but actually in Central Europe, retail sales are actually very positive. Most people have a job, that want one, and wages are increasing, so they're actually going out and enjoying their money, spending it in shopping centres and retail parks and so on. Not every shopping centre or retail park is a winner, but there's certainly there's good news for it in some parts of the region. So online sales is taking a fair chunk. In Czech Republic, it's around 12-13%. I think Hungary, 7% of your retail sales is down to online. Poland, less, at around 4-5%. So there's still also a long way for that to grow, to get up to the levels of, for example, the UK, where it's in the mid-20s. But retail sales reasonably positive. Now, unemployment. This is a double-edged sword, because obviously, if people have got jobs, it means they've got money and they can spend, and that's good for retail. But obviously, it drives up costs for our industrial and office occupier clients, and it's getting difficult. So as you can see, Czech Republic there, I think it's around 2%, and this obviously impacts on inward investment from companies. They look at the region and think, there's a shortage of people. Where are we going to find our people? Do they have the right skills? So going forward, this is an issue. Some companies are tackling this with robotics, automation, but it can also go too far. So if you fully automate a process, do you need to be in CE? If you're a German company and you have a fully robotic warehouse or production facility, does that need to be here? I don't know. Probably not. But there are other reasons for that. Moving on to investment flows. I mentioned a 10-year cycle, as you can see, with a slight blip this year. So we've probably reached the peak. But at 13.4 billion euros, the region is performing very well. As you can see there, Poland at the bottom in the dark blue. It's a 55% share of volumes, 7.4 billion for the year, followed by Czech Republic with around 3.2, and then Hungary 1.7. Again, there's not a shortage of capital that's looking to buy product. It's more of a shortage of product for that capital to place. Last year, or in 2018, there was about 14 billion traded, but about 70 billion which didn't find a home. So there's quite a lot of frustrated capital out there. So where's it all going? It's going mainly into offices, 51% share bought into offices. Retail behind that, but obviously subdued. Far fewer investors are willing to invest into retail at the moment. But that's also, and the same with industrial, it's also held back by the fact that quite a lot of the best performing retail and best performing in logistics is owned by a small number of players who are long-term holders. So that product's not entering the market. Hotels have performed pretty well this year, or in 2019, and going forward. Just this year, the Blackstone sold its residential portfolio in the Czech Republic for 1.3 billion. So that will make a big dent on Czech's volumes this year already. Where's the money coming from? So actually, quite a similar picture to between 2018 and 2019. Traditional investors from Western Europe, Austrians, Germans, Dutch, and a few others there, taking up to about 25%. Instead of South African money, which we've seen quite active in Romania and particularly Poland, to some extent those have largely been replaced by South Asian or Asian capital. Not just South Koreans, but they were responsible for the best part of it. And again, the question is whether they are still here or will continue. Some think no, their advantage, foreign exchange advantage, has disappeared. However, there's still Singaporean money, there's still Chinese money, who again, we believe that Chinese money there's still plenty of it and will come in good waves. But also Filipino, Malaysian. So there's a broad variety of Asian capital that has the potential. US and UK money have been largely net sellers, but they are there in the background and potentially will come. But really the big story there is CEE domestic money. And when we're talking about CEE domestic money, we're really talking about Czech and Hungarian capital. So in Czech Republic, Czechs investing into Czech was about 35%, and Hungarian capital investing into Hungary was actually 68%. But it's not only about investing into their domestic markets, it's about investing cross-border. So we've seen, obviously, Wing, and we'll hear from Mr. Steinberg later on, investing into Poland. CPI Group also investing into Poland, but also elsewhere in the market. So again, a very good diversity there of capital source. This is just quite an interesting slide, as from Preqin about private equity and what their money is sort of targeting. So as core opportunities are a little bit more tricky to find these days, they are adjusting their strategies to chase returns. So according to Preqin, private equity will be looking more at opportunistic and value-add opportunities in the years to come. Whether the availability of those is any stronger, we will see. But certainly an interesting one to follow. Yields, where are yields? So I've got here 2007, so pre-financial crisis, and current figures. So as you can see, apart from the two red numbers, almost all yields are well below where they were in 2007. So pricing is quite sharp there. We've moved Czech Republic's offices down to 4%, thanks to our friends from South Korea. The interesting one there is possibly, it's a bit offset actually, not on purpose, but shopping centre yields have moved back inwards from around 4% to 4.45 in Germany as a blended yield across the four main markets there. So again, whether we expect to see that similar trend come to Central Europe, whether those long-term holders or others will look to sell, and whether they will adjust pricing. Logistics, again, getting quite interesting there. A lot of demand on the logistics side. Just looking at, these are all prime offices, just to sort of demonstrate how real estate still remains attractive. So these are the spreads between Bulgaria at the top in blue and Germany there in the grey. So although Czech and Poland, or Prague and Warsaw, are fairly tight against Germany at the moment, the additional spread to government bonds is still quite a reasonable spread there. So real estate still is a very compelling story versus other investment vehicles such as equities, which are obviously a bit more volatile. Investors still find real estate a relatively safe bet. Otherwise, low interest rates continue. There's some indicative figures there on loan to cost for construction and loan to value on investment. These are from Polish figures. These will vary depending on the bank, whether it's a national money or international money. But again, some indicative figures there. But as I said, real estate is still very attractive to most investors. There's still plenty of capital out there. Most investors just see it as an interesting and safe investment. So just to summarize, there are some economic headwinds that we're seeing. We're not immune to those. Our economies are performing very well, but the neighbours, our trading partners, such as Germany and other markets such as the UK and the US, these will impact on us going forward. Not at the moment, but we will see those. Interest rate rises, as I said, are still attractive. Our leasing markets are performing very well. Looking at the recent figures for Budapest, gross figures, but 600,000 take-up and a 5% vacancy rate roughly. This is very attractive, and investors look at these and gives them confidence going forward. Do we have enough people to fill the 600,000 square meter pipeline? A good question, but it's a similar story in Warsaw, in Prague. We've got some strong development pipelines there. But overall, the general consensus is that the markets are performing very well. Wage growth is a concern, but it's also positive for retail. So the question is whether we will see some liquidity returning to the retail sector. We'll yet to see. On the negative side, interest rates could move out. And again, that will make things a little bit less comfortable for some investors. Supply and demand of assets is a continuing problem. Again, some sellers will be hesitant because if they sell, they'll have some great money, no doubt. But where are they going to put that money next? EU funding is a bit of an issue at the moment. Again, they're waiting obviously for the UK to leave so they can then renegotiate and see how much money they've got to share around. and I said e-commerce there has some risks going forward, but it's also an opportunity for the logistics sector. And I think that's it.